Let's understand how high ROC is creating high PE ratios for your companies. Let's take an example of Google, one of the most well-known companies. So let's take the last 4 years of Google, starting from financial year 17-18 and ending with financial year 2021. We have the capital employed of Google year after year. We have the operating profit earned by Google year after year, tax rates, and the operating profit after taxes earned by Google year after year. So let's start first with the profits. So in financial year ending 2018, Google earned a operating profit after tax of around $26 billion. Next year, that increased to $30 billion. In 2020, it increased to $34 billion. And in 2021, it has a massive leap and it increased to $65 billion. Now look what is happening to its return on capital year after year. Its return on capital on 18-19 reduced a little. It almost stays the same. And since you had such a huge boost in profit, it jumped. It jumped from 30% to around 47%. At the same time, Google is reinvesting its profits back into the business. As we can see, on 31st December, the capital employed of Google was around 72. It increased to $97 billion. Almost the entire amount of profits had been reinvested. Again, the Google reinvested the profit back of $120 billion, and a huge amount is again being reinvested in 2021. And the total capital employed of Google at the end of that period is $140 billion. The return on capital can be seen on this pattern. Now looks what happens at the price of the Google as compared to its EPS. The price of the Google is rising, and as well as its EPS is also rising. The percentage increase in EPS is 12%, 19%, but look what happens, the percentage in market price. It increases to 30% as compared to the last year, and it again increases by 30% as compared to last year in financial year 1920. And again, since it has such a huge increase in EPS, it was bound to increase, and it increased much more than the previous years. See, this loop of reinvesting the money back into business, earning higher return on capital year after year, creates a loop where you are effectively earning or building your wealth as an investor because of increase in market price of your company. This is how a high ROC leads to higher EPS and a much higher PE ratios for your companies, and consequently a much better return for you as an investor.